If you've ever opened up your brokerage app, typed in a stock ticker, and checked out the company's profile, you've definitely seen it. It's right there next to the stock price and the market cap, that little abbreviation, the PE ratio. Apple's got one, Tesla's got one, Nvidia's got one. Pretty much every retail investor looks at it, and I bet we all asked the exact same question. Okay, does this number mean the stock is way too expensive, or is it basically on sale? Well, welcome to The Explainer. I am so excited you're joining me today because we are going to completely demystify this metric. It is literally the most popular valuation tool in the entire financial world. We're tossing out all the confusing Wall Street jargon, and we're just going to look at exactly how the pros value a business. By the end of this, you won't just be staring blankly at that little number on your phone. You'll actually understand the massive story it's telling you about a company's future. Here's a super quick roadmap of what we're covering today. First, what actually is the PE ratio? Second, why the PE matters. Third, low PE versus high PE. Fourth, real-world examples and the PEG ratio. Fifth, trailing versus forward PE. And finally, number 6, what is a good PE? All right, let's just jump right in. Section 1. What is the PE ratio? The core math. Okay, so PE stands for price to earnings ratio. At its absolute core, it really just answers one super simple question. How much are investors willing to pay today for exactly one single dollar of a company's earnings? You see, when you buy a stock, you aren't just buying a ticker symbol. You're buying fractional ownership of a real-life business. That means you have a claim on a tiny fraction of its profits. The PE ratio? It's basically just the price tag for those profits. Let's look at the math, and honestly, it's incredibly simple. You just take the current share price and you divide it by the earnings per share, which you'll often hear called EPS. So let's say you're looking at a stock trading at $100, and over the last year, that company generated $5 of profit for every single share that exists. Well, 100 divided by 5 gives you a PE ratio of 20. The big takeaway here is that you're paying a multiple of 20. You are literally handing over $20 for every $1 of profit that business makes. Make sense? Section 2. Why the PE ratio matters. Finding value. Think about it like you're buying a local business. Imagine you're walking down the street and you have the opportunity to buy one of two coffee shops. Coffee shop A costs you $100,000, and it brings in $10,000 in pure profit every year. Now, coffee shop B also costs $100,000, but it only generates $2,000 in profit a year. Which one are you going to buy? Obviously coffee shop A, right? It earns way more money relative to its price tag. If you run the numbers, coffee shop A has a PE of 10, while coffee shop B has a PE of 50. Generally speaking, a lower multiple is a much more attractive deal because, well, you're getting more earnings for your money. But here's the catch. A PE ratio is totally meaningless in a vacuum. You can't just look at a random number, say 15, and decide, yep, that's a good stock. You have to frame your expectations. First off, compare the stock to its own historical average. If a company normally trades at a PE of 25 and today it's sitting at 15, that might be an incredible bargain. Second, only compare it strictly within its own sector. Comparing a boring traditional bank to a hyper-growth cloud software company is a huge mistake. Tech sectors naturally carry higher PEs than stable, mature sectors like utilities. It always has to be apples to apples. Section 3. Low PE versus high PE. The danger zone. A lot of beginners assume that a low PE ratio is just an automatic green light to buy. Like, oh, it's on sale, right? Well, actually, no. Welcome to the ultimate investing mirage, the value trap. A value trap is a stock that looks like a fantastic bargain because its PE ratio is sitting way down there in the single digits. But in reality, the market has correctly priced the company lower because the business is actually dying. It's cheap for a really good reason. So how do you spot one of these traps? You gotta look for the red flags. Is the company facing massive technological disruption? I always think of video rental stores, right when streaming started taking off. The stock looked super cheap, but the whole business model was becoming completely obsolete. Other big red flags? Shrinking profit margins, gigantic debt loads that just eat up all their cash flow, or a company that's sitting at the very peak of a boom and bust industry, like mining, right before commodity prices fall off a cliff. There's a fantastic quote from our research that hits the nail on the head here. If the business model is broken, that EPS is a melting ice cube. It is only a matter of time before the denominator in our equation catches up to the falling price, revealing that the stock was never actually cheap. Think back to our simple formula, price divided by earnings. If the earnings, that denominator, are collapsing, today's single-digit PE ratio could magically turn into a sky-high PE of 50 by next year. You didn't buy a bargain. You basically bought a ticket on a sinking ship.
Section 4. Real-world examples and PEG. The growth factor.
Let's try comparing two companies again. Company A has a stock price of $50. It earns $5 a share, giving it a beautifully low PE of 10. Now, Company B costs $200, but it only earns $4 a share, which gives it a massive, expensive-looking PE of 50. If you just stopped right there, Company A wins hands down. But wait, let's add growth to the mix. Say Company A is only growing at a sluggish 3% a year. Company B, on the other hand, is expected to grow its earnings by an explosive 40% annually. Suddenly, Company B might actually be the smarter investment. People are willing to pay that high multiple today because they are buying massive future profits. To actually measure this, Wall Street pros use a brilliant tool popularized by the legendary investor Peter Lynch, the PEG ratio. It stands for price/earnings to growth. You just take that PE ratio and divide it by the company's expected annual growth rate. This tells you if a valuation actually makes sense given how fast the company is growing. A general rule of thumb is that a fairly valued company will have a PEG ratio right around 1.0. It's an absolute game changer because it levels the playing field, letting you compare a slow-moving utility stock with a high-flying tech stock. Section 5. Trailing versus forward PE. Past versus future. When you're scrolling through your financial apps, you're actually going to notice two different types of PE ratios. Trailing PE uses the cold, hard facts, the actual, literal earnings the company generated over the past 12 months. Forward PE, though, is totally different. It uses expected future earnings based on what Wall Street analysts are guessing will happen over the next 12 months. Forward PE is usually a lot lower for fast-growing companies because, well, analysts are predicting much higher profits down the road. But the real question is, should you actually trust those predictions? Financial researcher Joachim Clement dug into 20 years of data across the US, UK, Eurozone, and Japan to find out. He wanted to see which metric actually made investors money, and his conclusion was wild. Buying cheap stocks based on trailing PE actually outperformed the market, but buying stocks based on a cheap forward PE, that actually destroyed portfolio performance. Why? Because analysts are frankly terrible at predicting the future. They almost always overestimate earnings. Clement puts it super bluntly. Never, ever use forward PE ratios, ever. Seriously, stick to the facts, not the predictions. Section 6. What is a good PE? The expert reality. So after all this, what exactly is a good PE ratio? Well, the expert reality is that there's no single magic number. Why? Because the PE ratio has some pretty severe limitations. For starters, it completely ignores the company's balance sheet. You could have two companies with a PE of 15, but one has billions of dollars in cash and the other is drowning in toxic debt. The PE ratio literally doesn't care. Also, it can be artificially pumped up or down by share buybacks or one-time events, like selling off a piece of the business. And lastly, if a hot new startup is losing money, its earnings are negative. You can't divide by a negative number, meaning the PE ratio is completely useless for valuing early-stage growth companies. Ultimately, the PE ratio is an incredible starting point. It's a really quick snapshot of what the market expects, but it is definitely not the final verdict. Relying on it alone is kind of like buying a house just because you love the color of the front door without ever checking the foundation. You absolutely have to look at the debt, the cash flow, and the company's competitive advantage. So I'm going to leave you with this question to chew on the next time you open up your investing app. The PE is just the beginning. What else is hiding in your portfolio? Keep digging, keep learning, and I'll catch you in the next explainer.